we've talked a lot about silver and how the open interest in silver had declined from 184,000 contracts in June to 154,000 in September. This means that there was covering in contracts. That means that the open interest was declining. Yet the price continued to rise above $40 in the face of a declining open interest. Declining open interest, meaning less people involved or speculating, and rising price, in theory, only happens in a bear squeeze, where the shorts are covering because they're afraid. And now I would argue it's rising because the long speculators realize that metals are in a bull market. And you got to wonder what the shorts are thinking right now as it continues to move higher. But you see all of the silver coming in, almost 11,000 tons of silver have come in this year. About 60% of global mine supply for 9 months have come into the United States. And so basically what you're seeing is, I think, a reawakening again of what silver has to offer. Now, if being on the short side of this has to be terrifying, as we're seeing now massive investment interest in there. Maybe this is why we're seeing such a huge short position in SLV. They're running out of ways to hold the price down. And in the face of rising short positions, silver and gold are still doing well. Of course, they're doing it in SLV and GLD, a little bit more opaque, instead of putting it right on the COMEX. But even still, you're beginning to see big money start to challenge the suppression of gold and silver. And I don't know, I think that it's not just gold and silver, it's platinum, which is up almost 65% this year. And so, yeah, you're seeing, again, what's China doing with platinum? They're importing platinum at a run rate of 58% of global mine supply. Again, it's not just gold and silver, it's everything. Precious metals, base metals, commodities like soybeans. They're doing everything they can, and they're paying for it and doing it in ways that are pushing back against the dollar. But to my point about the short positions, the short position in SLV exploded 67% higher, and gold almost 70% higher. This is aimed at keeping metals down. Now, normally such a barrage of these shorts would crush the price. It's textbook suppression. Flood the market with borrowed shares, push the chart flat, kill the momentum, kill the rising price. But the effort, this enormous effort to hold it down, is pale in comparison to the demand, which is even stronger. And I think that's very, very scary to these shorts. If gold and silver are holding this strong under record short pressure on SLD and GLD, what happens when that pressure fails? And I think it is failing right now. So yeah, I would expect to see much higher prices in gold and silver moving forward. I really do. And I don't know, I think it's just the beginning, Dunnigan. The demand is really strong right now. Supply, which has been really good for a while, is getting very tough. And why is that? It's because supply was so good that the dealers didn't re-up. And with the rising prices, the cost of carrying this stuff is very expensive. The cost of shipping it has become very expensive. The cost of insurance to ship it has become very expensive. Just the cost of holding a large inventory has become very expensive. You better have millions and millions and millions of dollars in order to run an inventory, or you have nothing. And so, I look at our inventory, which I'm not happy with it right now. It's gotten so low so fast. And this is one of the things I was concerned about. And I say this on your show all the time. Just like that, it changes. And the market does change. And it wasn't just the companies like ours that feel this. It goes all the way up to the primary distributors who, again, they were choking on product too for a while. Like you said, that was slow at the beginning of the year. And just like that, it's not. And there's lag time between getting new product in from around the globe. The U.S. Mint, who really is the model of inefficiency, can never keep up adequately. And this is with now just a glimmer of new demand. And maybe it's coming from higher levels because you're getting this advice coming from Morgan Stanley and Jefferies and, Bank of America. These people are talking, the CIOs or Michael Hartnett's of the world aren't talking to Jane and Joe Sixpack. They're talking to their institutional clients, their big money clients who are paying huge money for Michael Hartnett's writings. And same thing with the chief investment officer of Morgan Stanley. That's not stuff for the public. You pay for that stuff. This is the stuff that's given to their big clients. These are the people who are making moves before the public. The little man is still sitting in the Mag 7. The little man is still sitting in traditional assets that are not really doing or set up to do as well if things continue as the insiders are selling and the public is all in. It's something that concerns me, honestly. And you've had me on your show here now talking about this really since 2024, where it's been slower than we would expect in an environment that shouldn't really, if you look at the facts, it shouldn't have been slow. But now people are waking up, not just the diehards that you and I have spoken to forever, the mainstream, just a little sliver of it, and probably the sophisticated side, the well-informed side, more so than the masses. But when you get, Dunlock and Bank of America and Morgan Stanley and Jefferies all saying the same thing, that's going to change. And now all of a sudden supply is becoming tougher to come by. Premiums are rising, and it doesn't take a whole lot of demand to wipe out inventories that have not really been aggressively added to. So we are in the process of doing that right now, but there is a lag time. And I would say to you, you haven't seen anything yet in terms of demand. If these guys are right and they're telling, putting the seed out there that, hey, this is about to explode, just a small uptick from the public will decimate availability in this industry overnight. And I don't say that lightly, I mean it sincerely. There's so much money out there, not to mention M2 spiking right now, money creation and just money in circulation that's been sitting on the sidelines in places like money markets and in treasuries, which are now being, maybe you shouldn't own so many, reevaluated by the people who sell them. I think that ultimately, I've said it before, I'll say it again, I'm not talking my book. I'm not trying to get you to run to the phone and make a phone call, but I'm dead serious. I really do believe that this market, before it's all said and done, will be looked at two ways by the people from the outside. Geez, prices got so high, I'm out. And the people on the inside, I want more, but it's so hard to get it. And the prices, the premiums are high and the delays are high, and used to be so easy to get it. I took that for granted, and now it's next to impossible. I believe that'll happen. I do. Because on our interview with Rick again this morning, he talked about the 0.5% allocation. What if it's 5%? Well, these guys are saying 20 and 25%. If it went to 25% or even 20%, well, that's a 40-fold increase. Just like that. Do you think that this industry can survive a 40-fold increase? Not a chance in Hades. And it would be lucky to survive 24 hours with a shift to that magnitude. And if they're saying 20 or 25, what do they really mean? Well, and it's not even the mainstream talking about it yet. These are the top analysts at commercial banks who are not speaking to the public. They're speaking to their institutional clients first. Again, the big money. So the big money, the central banks and the commercial banks, well, they've already got their seat at the party. Now they're saying to their big money who they want to take with them on the ride, reallocate. But the people down here, they don't hear any of that yet. When they're told to reallocate, you might want to start to think about what happens next, because the big money will have been in position long ago. And that's when all the profits are made. And again, we don't buy this stuff to get wealthy. We buy it because it is wealth. And the biggest money in the world is signaling that right here in front of us. The only cure for the slow real estate market is lower prices or higher interest rates, not lower interest rates, because lower interest rates, again, is what got us into this problem and created distortions in asset prices. This is where the mistakes are being made. If interest rates were fairly set, cost of money would be sufficient enough where asset prices would come down. And that's the thing. By pushing the Federal Reserve into lowering rates, I fear we'll see the same thing that we've seen in Canada and in England, where they push the front end of the yield curve down and the back end says, no, thank you, and goes the other way. Because they're like, well, you're never going to get your balance sheet in order. So, if we're only going to accept this low rate for an extended period of time when inflation and money creation is eating away, completely rendering a negative real return, I'll pass. And I think that's what you're seeing. So, yeah, you're right. If you're not out early, you're probably dead in the water. And that's why you have no showings, and because it's just unrealistic. And I think people are concerned about the real estate market. During the pandemic, people wanted to get to somewhere they wanted to be to in Florida and in Texas, these states that were pushing back against the conventional popular rhetoric surrounding the pandemic. And now it's cooled off a bit. And I think anyone who would be paying, these high prices is going to think twice about it, especially with higher interest rates. People don't have the ability, higher rates in the mortgage market. They don't have the ability to take out debt the way they did a few years ago at 3%, and double the cost of money if they're not paying with cash. Yeah, you not only have people who would be nervous if this is sustaining, but also just have too hard of a time either getting qualified or being able to afford it. The real estate market is a scary one for sure. And you put those big institutions like BlackRock and Blackstone, put their feet to the fire and they get nervous and start dumping, thousands and thousands and thousands of homes. We will see the real estate crisis of 2008 look like a party compared to what it will be this time around with all of that investment in the market.